Good morning, traders. Today is the 9th, Saturday, July 9th. I'm updating this as of Sunday. This is the weekend update from Mint.com, covering everything you need to know going forward over the next few weeks in the markets. Couple of things I need to alert you to. I've increased our bond allocation by 10% this week. I believe the markets are entering a critical transitioning phase, and a couple of things are taking place. Metals have capitulated to the downside. You'll see that metals have moved into bearish trending on my rotational modeling system, which I believe is a crisis phase for the markets overall. We're seeing defaults in Sri Lanka and credit risks throughout certain areas in South America and other areas. I believe this is going to continue to escalate. I believe, in short, that the Fed has run what I call a Reagan Trap. Many of you that are above 50 or 55 years of age remember Reagan basically running a spending plan with Star Wars and with spending after Carter, which pushed the default of the Russian state nation into place after about 7-8 years. And it was a matter of essentially outspending them, letting them run into debt, and then watching their markets collapse on a debt-heavy basis. I think the Fed may have inadvertently done the same thing by running this easy money policy for the last 12 years, pushing foreign nations to borrow. And now that the Fed is fighting inflation, potentially raising rates again in the next 20 or 30 days, and potentially moving these very debt-heavy nations who were unprepared for an aggressive move by the Fed into sort of a debt trap. So I'm calling it the Reagan Trap. Right now, I'm calling it the Reagan Trap because I believe the Fed is going to do what it needs to do, given what's going on in the market, and have little regard for foreign capacity to settle and manage debt, which could push a lot of nations over the next 4 to 6 months into some sort of a crisis mode. Think of Greece. Think of what happened to Russia when their economy collapsed and restructured. This could become the norm over the next 12 to 24 months as the Fed continues to run their game. Now, what will happen is the strongest economies on the planet will become the benefit of a huge amount of capital and cash, and this is likely going to move bonds, U.S. bonds, higher, and possibly send metals skyrocketing. I will tell you that even though we've seen a downward trend in metals, I'm still very, very pleased with the capacity of metals to hold up in this trend. Remember, gold is trading at like 1730, 1740. Silver is at 19 and change. Compared to the $13, $14, $15 in silver and $1,300, $1,400 gold prices, we're still at tremendous valuation in gold and silver, and I believe the fear that's going to take place in the market related to what I'm calling the Reagan Trap is going to push these quite a bit higher. Now, let's go ahead and highlight the, so remember, we are now looking to try to get a little bit into bonds. I'll show you the bonds chart here in a minute. We've moved from 5% bonds here to 15. We've moved from 10% to 20 here. We've reduced our cash position by 10% here, reduced our cash position by 10% here. We are going to dabble a little bit back into the bonds market as metals and U.S. bonds are likely to become safe haven. Stocks, we're going to hold the 10% position, and cash, like I said, we've reduced a little bit here to diversify back into bonds, looking to see if we have any opportunity to bottom here. I'll show you that as we go forward. Metals have moved, oops, wrong direction. Metals have moved into bearish off of this selling last week. The Nasdaq is still in bearish territory, long-term and short-term. Everything else is still mixed. Long-term bullish, short-term bearish. We haven't seen any change of that recently, but things could change. I'm going to show this to you as we move forward. Oil is still long-term bullish, short-term bullish. Transportation is still long-term bullish, short-term bearish. Dow Jones Industrial, long-term bullish, short-term bearish. SPY, long-term bullish, short-term bearish. We need to see something really transition and break in the market. Now, there's two things that I'm going to try to highlight to you today. Number one, this chart here by the Fed. Now, I created this chart. I normalized the inflation red value by multiplying it by 10,000, and I normalized the velocity of money, M2, by multiplying it by 40 grand, so we can kind of get an idea of what's actually transpiring, all in the same scope. Okay, I also normalized the balance of payments, basis, goods and services, trade balance, by turning it from negative into positive. So understand that this means we have a higher outflow of trade balance. This means that we are reverting back to a better trade balance. So this, what's showing here is positive in blue, is really negative in the scope of things. So what I wanted to point out is that since 2020, the U.S. trade balance has really negated a lot of activity. Now, we've seen a big pullback here recently, which is likely due to the commodity structure and the actual tax revenues and things of this nature that's taking place with regards to goods and services. So we've seen a huge outflow. Now, we haven't seen this type of an outflow until prior to the last major recessions. The dot-com bubble here with a collapse, and then the peak in 2006, 2007 as the Fed was raising interest rates before we saw this outflow. But what's really interesting is consumer price inflation is rallying from extremely low levels. This does not yet carry current inflation coming back up over here. So understand, inflation has been up near 8%, 7-8%, which is going to put it up in this area here. This is a huge increase of inflation, bigger than we've seen at this point, or even back here in the 1990s. We're seeing a massive upshot of inflation, while M2 money velocity is still rather low. So what's going to happen here is we're going to see a tightening of spending. We're going to see trade balances reconstruct, probably fall, which is going to be globally. Demand for certain things is going to be altered dramatically. I see no other outcome here other than we fall into some sort of a recessionary trend. And I also see it being led by foreign markets. Unlike the last time, it was led by U.S. market, global financial crisis, and the dot-com bubble. This time, I believe what I'm calling the Reagan Trap has been sprung. The Fed moving rates another 0.5% or 0.75% higher will lock the trap into place, and then it's just a matter of time before these debt-heavy nations absolutely collapse. Next, we are going to go, oops, wrong chart. We are going to go to this, which is a custom chart I just created this morning. What this is a custom measurement of upward and downward volume activity in the New York Stock Exchange. And what I wanted to highlight was how buyers and traders are still inching and nicking away at buying into these dips right here. That's what this is showing us with these spikes, is they are still buying into these dips, thinking that the Fed is going to be able to rescue the world again in this capacity. And what we're seeing here is every time we tend to move downward, we get some support. We're seeing these buying into the dips, which probably coincide with Fed statements and Fed meetings indicating that, you know, they're raising interest rates. So we've seen this last little buy into the dip right over here, June 27th. Now we're into early July. We've seen some stalling here in the SPY. You can see here we've got divergence into this volume activity here. We're not seeing a real solid upside volume. We're getting some divergence. Something is going to break, ladies and gentlemen. It's either going to be to the upside or the downside, and given what I'm seeing in the markets, I'm seeing that we're likely going to see some sort of a downward pricing pressure overall over the next 2 or 3 months, possibly 4 to 5, 6 months. I'm seeing some downward pressure in the U.S. market. The U.S. markets are still holding up extremely well, and I want to be very clear that the U.S. markets are going to benefit from weakness globally, but at some point, there's going to be some sort of a capitulation or contagion event, which is going to cause the U.S. markets to fall quite a bit as well. This type of Reagan trap, as I'm telling you, could prompt a series of corporate, state, and nation type defaults over the next 2 or 3 years. We'll see how this plays out and what the Fed's actually going to do. Now, one thing I wanted to highlight before we go on to the others is this chart. This is a new chart again. I'm calling this the Custom U.S. to Valuations Trend Index. You can see we've had kind of a buying of the dip over here recently. This is a weekly chart. You can see we've had a buying of the dip over here, back up to these 2020 levels, 2019 levels. I feel we're going to stall at these levels and attempt to move back down into these levels somehow. So this is an inverted chart. This is showing you that we are, in reality, where we're at is about the 2019 highs in terms of overall trend mechanism. And when we take a look at the chart, you'll see that we're not even near these 2019 highs overall. So if we see a breakdown in the U.S. markets, the next logical scenario here, ladies and gentlemen, is right in this area, which is the 2017 highs, or down here into the 2018, late 18-19 highs, which would indicate another at least 30 to 35% downside in the Nasdaq and the SPY. So I'm going to keep this in mind as we move forward. We are going to go to the consumer index, consumer engagement index, showing some strength last week. There are reports now that auto loans are in exceedingly high default rates, lots of repossessions in autos. A lot of people went out and bought autos over the last couple of years, and the tightening in the markets right now and higher interest rates may have caused them to default on their loans. This is an early warning sign. I think that we're going to see consumer engagement stall at this level and then weaken a bit further. I don't see any way out of this. I don't see the Fed lowering interest rates. I see the Fed raising interest rates, maybe by a quarter, maybe by a half, but continuing to put pressure and watching inflation attempt to deflate or change direction. But consumers are certainly taking it on the chin right now. This little blip back to the upside on this chart, remember this is a monthly chart. This little blip here in early July shows that consumers that still have cash on hand are spending, but not nearly at the level we saw before. We are already way back into 2013-14 levels, trying to hold at this level. It's been holding at this level for a while. But a big breakdown, if we saw a breakdown in consumer activity, would likely prompt a downward move in inflation. And consumers make up 60, almost 70% of the GDP nation for any nation. So consumer activity is critical. We need to see consumers move back in before we're going to start a big uptrend. And we are not seeing that yet. Next, we're going to see the large cap, the Bradley Custom Large Cap Index, stalling, finding some support. We're in a deflationary cycle trend. Excuse me. You can see we're in this deflationary cycle trend here. And this is inverted as well. You can see 0 at top, 3 down here. We've kind of reached this apex level. And again, what I was showing you is that on the other charts, we're back over to this 2013 down over here, or 2018-19 level in valuation, whereas the large caps are holding up quite well. This is telling you that global traders are still betting that the U.S. markets are going to be somewhat immune from the crisis event that is unfolding. And this may continue to play out for another couple of weeks or couple of months, but eventually I think the U.S. markets are not going to be immune. There's going to be some sort of a capitulation low, and for right now, we're going to try to avoid it by watching what's happening and moving to safe havens. This, again, is a transitional phase. What's happening is foreign nations are very heavy in debt. A lot of foreign nations are seeing contraction in consumer engagement, just like we're seeing here, but it's on a total different level. For example, the issues in Europe, in Italy, and Poland with the farmers, with the gas supply, with the cost, inflationary trends. I read something that in Europe, in England, for example, butter is like $10 for a pound of butter. Long and short of it, we're in a totally different world over here in the U.S., and we may see some of it, but what's happening outside of U.S. is totally different, particularly in South America, Asia, and Europe, and other areas. We're seeing pricing concerns and consumer unrest really come into play, which could present a very big issue eventually for the U.S. markets, because what happens around the world eventually happens to us as well in some form. So be aware that we're seeing some very real concern here, but it's not really affecting the U.S. markets yet. This is the Global Asset Index, which is stalling. This is a weekly chart. What I wanted to highlight here was how in 2020 we had the early February, March crisis. Even though assets collapsed, the real scenario here was we had a very big collapse in 2020 because of COVID with the U.S. stock market and the global markets. But in reality, global asset prices didn't really alter that much. We didn't see a huge change in traditional assets. We saw it mostly in the stock market and global indexes. They continued to rally as the Fed pushed and global central banks pushed more money into the economy. And you can see here it actually peaked and double topped from roughly August of 2020 to here in, let's see, August, September. This would be September, October. So this would probably be about November 2021. It double peaked, and now it's starting to weaken again. So now at this point, we haven't seen this move below the mid-2020, the bottom COVID area. We would need, if the global assets were to really decline, which is, again, this is inflation. This is showing you inflation bubble, a big asset bubble of excess capital in the market driving inflation. If inflation were to wane and we were to see global assets decline, we would see it move back down here into these 2019, 2018 levels. So we're at 66 right now. We would need to be at 88. That would be about a 26 to 30% decline in asset values, including homes and other assets. And this would be a deflationary trend. So this is showing us we are not seeing deflationary trends at all. In fact, inflation is starting to move back higher again. This is what it's showing us. Okay, gold custom cycle index updated as of yesterday. A real stalling out, which I predicted we could get some stalling in this area. This is why I'm calling this move in gold a capitulation bottom. You can see we've got this solid uptrend, this solid hook here, solid hook here. I believe gold and silver are setting up what's called a capitulation bottom, and will start to rally over the next 3 to 5 weeks, kind of like what happened after COVID and what happened after the 2008, 2009 collapse. It didn't take long for gold and silver to form a bottom and start to rally back higher, and then it rallied another 300% plus once the capitulation bottom was in place. I think we're at that capitulation or in the middle of that capitulation bottom right now. So gold and silver have turned bearish on our trend charts. Let me show you here. Gold and silver have turned bearish on these charts. Feel free to take any action you want to protect your assets. I am holding this long term based on what I'm seeing. I like the ability to buy gold and silver a little bit cheaper right here. 1740, 1750 is still much higher than the $1,400 level that I started buying gold at many years ago. I see this as a big capitulation bottom in the markets, and fear is going to drive gold and silver much higher. Next, we are going to come back to here, and we are going to go to the technology ratio, Bradley Custom Technology Ratio Index. Techs and Fangs are holding up near this base bottom. And remember, this is 2015 base bottom here, but I still believe we're missing that capitulation selling. So you can see here, we don't have real strong selling here like we had back over here with COVID, like we had back over here with the 2008-9 bottom. We're not seeing that yet. So remember, ladies and gentlemen, we might get a little bounce here in technology. maybe for another 2 or 3 days, but we're not seeing any capitulation selling here with volume. So we're still waiting for that bottom, that base to occur in this downtrend. The U.S. to custom global market index, okay, this is really important because you can see the foreign markets here, this orange or reddish color line, is moving deeper downward. We are seeing global market indexes weaken on what I'm calling the Reagan Trap scenario, and it's likely to continue. The U.S. markets, though, are moving a bit higher. And this is really telling you that foreign money is piling into this, thinking the U.S. Fed has got this, and the U.S. economy is the strongest economy on the planet. But we have not seen capitulation over here. A big breakdown in global markets because of the Reagan Trap or any other capitulation selling would likely transfer into the U.S. as another big breakdown, a leg 5 back down to lower levels. So be very aware that traders are buying into these dips. They're essentially following the norm, trying to say this is the Fed's got this, the U.S. economy's got this. But inflation could stick around a lot longer than we think, could lead to a global crisis, humanitarian credit debt type crisis, and I believe the foreign market is where we've got to keep our eyes right now. Foreign market collapse would translate into a U.S. market type of contagion, no matter how we look at it. And unlike other collapses, remember in 2020, this was a global collapse. Everything went down, U.S. and foreign markets. 2008, 2009 was primarily a U.S. credit market collapse because of housing and the U.S. financial industry being unprepared for the derivatives and the mortgage-backed securities. This time, I think the Fed has protected the U.S. banks to some degree. Foreign exposure to debt could still be an issue. Foreign exposure or exposure to cryptos and other derivatives could still be a crisis. But remember, foreign markets are starting to react much more aggressively to what I'm calling the Reagan Trap than we're seeing in the U.S. Okay, the U.S. custom, U.S. to valuation index trend. Oh, I think we've shown that already. Okay, let me see. I think we've gone through these. Custom tech ratio. Yep, we have. So now we'll go to the Fangs Index. Fangs Index is showing some support, still stalling near this upper boundary of this channel. As I've mentioned to you before, I see a fifth leg back down here to the 400, 375 level, possibly deeper. So I'm going to warn you that don't get trapped into this buying yet. I don't believe that we're seeing any real accumulation in the markets. I think we're seeing, retail and other traders attempting to buy this dip, thinking the U.S. market is going to pull out of this with another rally phase. But you can see here, ladies and gentlemen, A, B, C, D, possibly E down to here. And I'm going to try to find something to show you later. But I'm still waiting for the final leg, ladies and gentlemen. So I'm going to tell you right now that no matter what you're thinking, understand this could be a bottom, this could be a base. We don't have any confirmation of it yet, but this could be just a stalling before we get into a final leg, a capitulation leg where we're seeing real selling volume. You can see we saw some selling volume here, kind of like what happened over here with COVID. So I need you to be aware this could be a bottom. This could be a technology bottom, but I'm very hesitant to call a real bottom yet because I'm not seeing it, and I'll show you as we move forward. So I'm waiting for another leg downward. Okay, U.S. stock market index. This really shows us what's going on. We're in a downtrend. We have no real capitulation yet. We don't see any real strength here. We're kind of just above these COVID highs, which I think need to be broken to see capitulation. In other words, we would see a downward leg down into this area, the 890, 900 area, or potentially lower down into this 780, 820 area I've highlighted in red. I believe this is just a stalling pattern here. Traders are getting somewhat aggressive, trying to buy into this dip. I see a lot of talk about upward movement in the indexes, but I think we have this Reagan trap going on, and I think we're going to see another downward leg with capitulation back over here into the 890 800 area, potentially down in this area before we find support. Next, the Smart Cash Index. Remember, this is the global index, and this is what's showing us kind of what's going on globally. You can almost see a new trend channel setting up across these highs. Excuse me. But we are at a risk of breaking down even further. If we see chaos and crisis in Asia and Europe and others, we could break down here to new lows, starting a new selling wave. You can see we've closed this gap already on a close. You can see with this line here, the next level for this breaking down from this level, if it does happen, is going to be down here where I've drawn this blue line, and then eventually these COVID lows. So understand that the global markets are the biggest risk we have right now. And again, that plays into what I call the Reagan Trap setting up, where at-risk indebted nations are going to have to roll their debt into new debt instruments at higher interest rates, which will put even higher pressure on these debt-heavy nations while inflation is ramping up through the roof. So watch what happens here. We could see the global markets really start to collapse over the next few weeks if the Fed continues to try to raise interest rates. And again, what that's going to mean is that nations that are capable of having any type of capital reserve in US dollar and or gold and or silver and or foreign capital may be able to withstand it better than nations that do not have these reserves. So it could create a whole kind of a domino effect where hypothetically Sri Lanka just went bankrupt. Next could be something, you know, like Taiwan, or, well, not Taiwan, but Thailand. Next could be El Salvador. Next could be Pakistan. There could be a whole series of nations that are not prepared for this right now. Never thought that the Fed would be looking at 3.5%, 4.5% Fed funds rate after being at 0% for so many years. And that's really the crux of the problem. A quickly advancing U.S. Fed fund rate, that is really going to be something that is going to take foreign nations by surprise. Okay, metals index, big breakdown outside of my my golden pathway here. This is what I'm calling massive capitulation. I'm looking for a very solid recovery back up to the 420, 440 area in gold over the next 3 or 4 weeks. We do need to hold above this 390 level, let's call it, this low. If it gets below this low, then, you know, I'm going to pull away from the hold metals position. This is really our critical low, and this has to hold up. A dip below this on a low, we'll see what happens. I don't know. But this is really capitulation. Now, there is news that Goldman Sachs was just fined quite a bit for manipulating the metals market. But this looks like capitulation to me, and I'm going to highlight this area. This was the COVID low, and you can see how we went up. We started having early warnings. Volatility got a lot bigger, and then all of a sudden, for a week or 2 weeks, gold just collapsed. And then all of a sudden, the Fed came to the rescue, and we had plans, and fear set up as the markets were very low, and people didn't understand what was going on. This was fear, and this drove gold from 320 up to 480. This was really a very big move. This was a move from like 1,500, 1,550 up to 2,000 in gold over just a 10 or 12 month period. Now I think we're seeing that same type of capitulation. I think this is a very strong, deep selling that's going to be reversed back to the upside. But remember, I'm watching this 390 area. This is likely going to be my line in the sand where I tell everyone, do what you want to do. The system is telling us to get out. The systems are right now telling us that everything is in a bearish trend. But this line right here, this 390 area, is my base for support. I think fear is going to come into play very heavily, and safe havens are going to come into play very strongly over the next 10 to 12 months. So take what you want from it. I'll tell you what I'm doing. I'm holding my positions. I've got long-term call options on silver miners and gold miners. I've got a stash of physical I do not see how gold and silver do not act as a traditional safe haven over the next 4 or 5 years. And that's why I'm calling this a real big opportunity. Yes, we're outside these ranges, but I'm willing to take that risk thinking that gold and silver could rally 500% to 800% or more over the next 4 years. And just as a safe haven, up in Canada, for example, their internet went down yesterday across a lot of Canada. Well, cash, if you remember what happened in Greece, cash, same thing. Their internet went down, their banking went down, and was limited to the amount of money you could pull out. Gold and silver become very critical at times of uncertainty and default. They become a basis. It reverts back to, coinage from thousands of years ago that you can still trade gold and silver and other assets as a form of barter, whereas paper money becomes worthless. And that's kind of what's happening in Zimbabwe, in Sri Lanka, and other areas. So remember, this is kind of the last bastion. The shiny metals are the safe haven of reserve stackers like myself, where we believe that this will continue to go because the Fed is pushing the markets into weird contagion structures. Like I said, the Reagan Trap. Okay, Valuations Index have really stalled out. Remember, we started this back over here during the COVID scenario. This excess phase bubble has completely unwound. Now we're likely to see this stalling. The next leg lower will probably move us below this middle red area and put us down into this lower area where we are likely to stay. This could be a continued stalling of the markets. Remember, this was 2018 when we saw some big collapses in the markets. The end of 2018, we saw a big 26-30% downside move because the Fed raised rates higher. We could stay in this lower area for the next 12 or 24 plus months as the Reagan Trap unfolds. So we are now probably stalling out, moving downward over the next 4 or 5 weeks. We just need to kind of watch for the bricks to hit the walls, so to say, or the glass. What's next? Is it going to be Italy? Is it going to be Poland? Is it going to be Zimbabwe? Is it going to be Africa? Is it going to be India? Is it going to be Asia? What's next? We need to just see how this is coming, but the unwinding is still taking place. So don't get overly confident yet. The commodity to gold index is doing the same thing, stalling out here again. Saw a little bit of a rebound over the last couple of days. This is inflation again. And this is really traders trying to buy into the dip, but this is a little bit more inflation. Still very, very low compared to where we were up at these excesses at 22. We're now at 2, so about 1/10 of where we were. Still within normal ranges and still within bottoming cycle ranges, but I don't believe we're done with the bottom yet. I don't believe we have any capitulation, and I'm waiting to see it happen. So again, stay very cautious. Try not to buy into the market like the retail buy the dippers are right now. I see a big move to the downside, a capitulation move taking place, and it's all going to be dependent on how severe that Reagan Trap plays out. Next, we have the Volatility Index. I had warned you that we might see a little bit of an upward move. I drew this line this week. This looks like a fairly new downward trend cycle here, consolidation. We've seen almost 2 months of consolidation below 10. We're not seeing these big pops up here in 12 and 14, which would show bullish trending. So at this point, we are in neutral bearish trending, and a breakdown below 6 here would move us into solid bearish trending. We are kind of consolidating in this downward channel with no real breakdown. And this is why I say we don't have yet a big capitulation move like we saw back here. This was a big capitulation move. This was a big capitulation move. This was COVID. You can see we had this capitulation move here just before the or during the elections in 2020. We haven't seen any real big capitulation selling, which would prompt some sort of a buying mode here yet. So we're missing this mode. Now, this leads me to believe that the U.S. market may see some sort of a an upward trend where foreign capital moves in to try to avoid risk, but it really is not showing that great of an opportunity here. A breakout to the upside would be short-lived. It might be powerful. It might be 6, 7, 10% if we were to get kind of an upward breakout, but I think it would be short-lived, and I don't believe traders should really try to bank on it. If you do try to trade the upside, my opinion is to trade very small allocations right now. I don't believe it's going to last. I think it's going to run into resistance right here around 11, 10, 11, 12 with this index, and then stall out and move lower. Okay, I think that's it. Yeah, that's it. So let's come back over here. Take a look at the ES chart. So this is my ES chart from last week. I did provide a great Fibonacci analysis video using my Fibonacci tool. And what we have here, ladies and gentlemen, if we were to count this as wave A, B, C, then we have D up to here, which is really here. Now we have what's potentially a complex wave setup. Oh, a little too tight. We have a complex wave setup here with a pennant formation setting up kind of like this in the ES. So we could call this we're at D here, setting up E down to here, and we have this pennant formation stalling here. We would have 1, 2, 3, 4 looking for a breakout to the downside here over the next 10, 15, 20, 30 days with the potential bottom somewhere around, let's see, August, let's call it early mid-August, somewhere between August 2nd and 20th, maybe setting up down here around the 34 level, maybe even deeper. And the reason for this is because we're very early in the count. So what we have here as a 1, 2, 3, 4, potential 5, this could be essentially A, B, creating a C. So hypothetically, an A, B, C wave, falling into this mode, creating a new retracement, followed by a further downside 3 to 5 wave structure. So understand that if this were the first wave from here to here, and I'll just move it to here, then the second wave C should be 1 to 1.5 times that move to the downside, creating a C wave. So this, think of this as A to here, B to here, potentially C down to here, D over to here, E possibly even further. Elliott wave is something that you have to be aware of that adapts as we move forward. And we're getting a very clear sideways pennant formation here in the markets. My initial construct, if we move to here and here, this is 5 minute, let's go here to daily. This is my Fibonacci price structure system. This is the ES. And you can see here how we have these constructs in place. So it is still projecting from this recent peak here that we have a downside range down in these areas, 3,400 to 3,160, let's call it. And we have an upward construct here at 4037, which is very, very important. But we need to pay attention to this upward area here. Let me highlight it for you. This area right here is the upper Fibonacci trigger level. So we will not be able to confirm that we are entering into any bullish trending until we get above 4,200, 4,208, which is where we have this line right here. So this tells us that we are in a downward trend. We are likely to break downward. We are not going to be considering any bullish activity until we're able to close confidently above 4,208, that green line level. That will tell us that we're in bullish trending. So at this point, ladies and gentlemen, that's why I'm warning you that this this pennant formation, which is very, very clear. You can see right here from these lows across here and across these highs roughly to here. There's the pennant that is likely kind of like the pennant that happened here. You can almost see another one right here. You can see this sideways channeling. See if I can draw this efficiently. So there's another type of a pennant. It came down 1, 2, 3, 4, and then broke downward. Here we have 1, 2, 3, 4, and then broke downward. So now I am expecting a downward price leg, failure above this level, which is likely what's going to happen here. Even if we got up into this area, it wouldn't matter. If we don't get above the 42.08, we're not going to see bullish trending. So let's go back over here and take a look at the Nasdaq. Lots of data over here on the Nasdaq. As you know, I'm very big into cycles and Fibonacci and Tesla theory and Gann theory. So you might not be able to understand this because I've drawn a whole bunch on it, but I do. And as you can see, we've got this pennant formation setting here in the Nasdaq. We've got what's called a false breakout here. In fact, let's come back over here just for the heck of it and check out the Nasdaq on, okay, I'll have to type it in. Oh, some lines from the video I made last week. Let's just leave those. And as you can see here, we have, based on daily chart, we have moderate upward trending above 11,815 right here. We have previous resistance right here at 12,570 on the Nasdaq. That's close to this line. And we do have that same type of pennant set up here, which we come across these lows roughly out to here and across these highs roughly to there. And again, we've got that same setup, ladies and gentlemen. So even though we have some moderate bullish trending in the Nasdaq right now, we're very close to that pennant formation. Be very cautious next week about a potential breakout, moderate, what's called scouting party to the upside here before it rolls over. Get rid of some of these lines. The real reality here is that we have continued downward trending. We don't have any new highs. Weekly data on the Nasdaq is showing us, again, we need to get above this level here, 12. Let's call it 12,675 roughly, 12,675 on the Nasdaq to see upward trending. We're already in a confirmed bearish trend. We need to get above this level to see any upward confirmation of trending, meaning bullish potential. And then it would have to get above this level, eventually breaking above this level, 15,350, before we're going to be able to attempt any new rally phase. So this has got a very strong downward potential right now. I'd probably say 70, 80% breakdown potential, knowing that we're just not above this critical buy level yet. And as far as downward trending, the weekly pivots on the Fibonacci system suggest 9,000. They suggest 10,650, and where we've already been here, 11,450 to 500 roughly. So understand that once this level here breaks, the next levels downward are this 10,600 and then 9,100 roughly. So understand, we have a long way to go. If we were to break this level and target the 9,000 level, you're talking another 25% to the downside on the Nasdaq. Okay, so I don't want to run too long. What I want to try to do is let's go over here and take a look at the TT Charger. It's following along with my scaling and what I predicted. So this is data from many months ago indicating that we were at a wave 4 peak and that we would likely come back down into this area trying to find resistance. This is the ES. This is the area that I really believe we're looking for support right now, which is below 3,400, which would be another leg downward. Hypothetically, another leg downward from where we're at right now would put us at another roughly 24% downward. So, whoops, this would put us at wave 4. And I want you to be aware that these are the levels that I had drawn, wave 3, wave 4, somewhere over here. And this is where we're looking for this bottom, or I'm looking for this bottom. So this is where I'm telling you, I think metals will really start to move higher. I think they'll start to turn into a safe haven where I think bonds will do the same thing. Reason being, I will tell you, is if the global markets move into some sort of a failure, then it's very likely U.S. markets will act as a safe haven. Foreign capital will pour into U.S. bonds and stronger economy bonds. Those are typically the Japanese market, Canadian market, and European market. Traditionally, those have been the strongest. We may see that China comes into play depending on what's going on with China and their debt load. But we're at this point right now where I'm expecting a capitulation bottom down here in this area. So let's come over here and take a look at the Nasdaq. Same type of scenario. As you can see, I've drawn this bottom here. We've already reached these lows, which was what I had drawn earlier, but we could end up down into this 50% retracement area. Let me try to draw this so that you are aware that we could see a blowout of a like a tech blowout, which could move us from roughly here down into this area, and that could ultimately be our low, which would be back into these pre-COVID highs. That puts us into a support level back down into this area between 0.50 and 0.618. Now pay attention, this Fibonacci is being drawn from the lows in 2013, 11, 12, 10, 11 to the recent highs. So we could get actually below these levels briefly, but I need you to understand that ultimately the support on the Nasdaq comes right in this area, which is the bottom of wave 2. So ultimately this wave 3 could continue to move downward aggressively towards this bottom. So this new level that I showed you, the downward cycle here could theoretically, if we're looking at, see if I can grab this little line here. There we go. This could move all the way down into this area. Another 50, 60%, well, from the top here, a 50 to 60, maybe 70% move. This would be an aggressive unwinding, and this could still qualify because as long as it stays above these levels, these, what I'm calling end of wave 1, end of wave 2, beginning of wave 3, new wave 4, as long as we stay up in this area, we're still technically in a pullback of wave 3. So we could have a long way to go with U.S. technology. I don't believe it's going to get to this unless something major happens, but we are still very, very early in this cycle phase. We're really at the point 382 level on the Fibonacci pullback, whereas we could move down to the 0.50 or the 0.618, which is a very big downside move. Okay, I think I'm going to leave you there. I think I'm going to move back to, where's the chart? This chart. I'm going to leave you here, indicating that we are seeing buyers trying to buy into the dip. We are seeing buyers, retail traders and global traders try to move money into U.S. assets as the dollar continues to strengthen. We are seeing divergence in volume activity and the SPY. We are not seeing capitulation volume. We're not seeing this deeper move like we saw here in 2018 and here in 2020. We are just not seeing that yet. We are seeing moderate deflationary trending in the U.S. market, and I'm looking for some sort of a capitulation move before the bottom in the U.S. market is in. That's why I think we're going to see a flight to safety. I think we're going to start to see bonds perform a little bit better. I think we're going to see foreign assets moving into U.S. dollar-based assets, but I think they're still a little ahead of the game right now. So stay cautious. Remember, we are going to stick with this plan. Oh, let me come in here. We are going to stick with this plan here, which is the markets are still generally long-term bullish. The Nasdaq is the only one that is bearish. We still have a little bit of exposure to stocks. We have most of our money in cash. We're holding on to metals as a safe haven, and we've just allocated a little bit of extra into bonds, expecting bonds to turn into a safe haven over the next 6 to 7 months and possibly start to rally. We are watching for the Reagan Trap to unfold, and we are going to stay cautious of the markets going forward over the next 2 to 3 months to see what the Fed is able to do. If the Fed is trapped into executing higher interest rates, then we are likely going to see this Reagan Trap begin to really bite into foreign markets. And when I call it the Reagan Trap, this is essentially running excess credit, excess debt, and then the Fed raising rates aggressively where foreign markets are trapped in an untenable debt position. So understand that this is where we're at. This is what I think is coming. This is our safe way to handle it. If you want to have a mix between this, which is our more advanced setup, and this, go ahead and do so. A breakdown, if once the major market trending, once this trending, oops, wrong direction, moves, once the ES and the YM and the TRAN and the SPY move into bearish trending, then I am going to move us out of these cash positions right now or into these stock positions. Right now, because we haven't moved into bearish trending, we do not have that deep long-term collapse. That's why we're holding this 10%. It's simply put, we do not have any long-term indication other than the NQ, the Nasdaq, that the long-term bullish trend is at risk yet. As soon as these flip, a predominance of these flip into bearish trending, then I'm going to move you into safety away from risk in stocks. But for right now, we're leaving the 10% stocks, which we have here, 45% cash versus 75% cash, 25% metals as a safety, safe haven, and then we just increase this from 10% to 20% bonds because I believe bonds are going to start to act, U.S. bonds are going to start to act as a very strong safe haven. So be aware, Reagan Trap is tightening. It may have already sprung. Could be another 6 to 12 months before we start to see the results of this, but I think what we're seeing in Zimbabwe, Sri Lanka, areas in the Gold Coast of Africa and others, I think it's going to continue to spring and do its damage. We'll see how it plays out. Okay, talk to you guys later.